most people, and depending on where they're at, life cycle wise, stage wise, most people don't want to have that mortgage payment, when they go into retirement. They
Hmm.
want a strategy. But to your point, which is prior to discovering the all in one, that was the approach I took with my clients. It was max out your mortgage and keep that money invested. And that still is, in my opinion, the better strategy. Now you've got to be comfortable with that. But even when you're doing that, trying to max out your mortgage, you still want to keep your interest expense as low as possible. And the all in one allows you to do that because you're always going to have, as an investor, most likely you're going to have some cash or, large sums of cash sometimes that are sitting there idle that are not being used.
Right.
And so, what this graph shows is the credit limit that you start at. So let's say it was that $400,000 loan. Um, you're going to have that credit limit available for the first 10 years. And then for the next 20 years, we're going to reduce that because it's 240 months is 20 years. So we're going to reduce it by 1/240th every month. So that 400,000, now by the end of year 20, you still have 200,000 available. By the end of year 25, you have 100,000 available. And by the end of year 30, you're down to zero. So you don't have a balloon payment at the end. And so the way people will take advantage of that, this is using an example of 500,000, is they start to see how fast they're paying down that principal. And then maybe they have college tuition costs come up and they start paying it down again. And maybe their income slows up a little bit, so it pays off a little bit slower. But at some point, it's paid off here, around year, 13, 14. And now they decide, hey, we're going to buy a rental property, pull that equity back out without having to requalify, without having to go to the
Mhm.
bank and say, hey, my credit is different, my income, I don't show it all. All the things that could, potentially go wrong with the all-in-one, you don't have to worry about that. You can pull back up to that blue line, max available still, and pull that out. Gets paid off again. In this example, a little bit later in life, they had some medical expenses and they paid
Yeah.
it off again. So it's nice that you can tap into that equity for an investor, and especially for people that are taking advantage of the infinite banking concept.
Right.
This is something where you can keep maxing that out and doing more and more with your money.
Yeah.
As you know, with the infinite banking, you're basically, it's allowing you to use your income twice. And those funds that are coming in, you're putting it into your infinite bank policy, and then you're paying your other bills and expenses and investments, and then using those investments to pay back the
Yeah.
the loan that you're taking from yourself or the loan that exists on the all-in-one.
Yeah, it's really taking advantage, especially getting back to Nelson Nash, really taking advantage the magic of compounded interest, right?
Right.
Because if
Exactly.
you're, I mean, that money is continuously growing. My grandmother, who was an algebra teacher in Columbus,
Wow.
she used to talk about compounded interest all the time and
Yeah.
tried to teach us about the value of keeping money in the bank. But
Right.
that was how we were taught, right?
Right.
And Mr. Nash was like, be your own banker, you know,
Yep.
and because he spoke about the miseducation of the American people about what life insurance is for and what it can
Right.
do. We only think of it as a death benefit, but it's not. That's why that's what drawn me so much to Index Universal Life, and what drew me to you is like there's so much different from what I'm in finance. I graduated in finance,
Yep.
right? It wasn't stump their feet like life insurance. That's the way to go. No, I mean,
Right.
I would never do anything else, but yeah, I mean, but
Yeah.
yeah, this is all of it. All of this is so fantastic because it's so different, and it goes into those spiritual matters of what money truly is, a way to
Right.
build your wealth.
Exactly. Yeah. It allows you to build legacy. I mean,
Hmm.
the IULs and the whole infinite banking concept, the legacy play there. Um, and people look at it and they go, well, it's going to take a little bit of time for that to build
Yeah.
up, right? Well, it's not that much time, and the time's going to go by either way.
Yeah.
But but the other thing becomes is like, well, if I took that money and let's say I invested it instead in the stock market,
Mhm.
one, I've got risk. You don't have the risk with the
Right.
IULs.
Right.
I mean, you could lose your principal in the stock market, but let's say, the S&P 500, I think, what, an average, 9%, nine and a
Yeah.
half percent return. Um, you know, great, but what happens if, God forbid, 2 months after you put the funds into your stock account, you get hit by a bus, you know?
You lose it, and most people say, hey, that's the stock market. It goes up, it goes down, eventually you
Yeah,
get to zero. No,
right.
it doesn't. You lose your principal. So
Yeah,
if you have $100,000 and the market goes up 50%, you have $150,000. If it goes down from there 50%, what? Well,
you got 75.
75,000. Yeah, you lost. You're
Right.
below the
Yeah.
$100,000. With insurance, with cash insurance, all cash insurance, the money inside of it grows tax free. You
Yeah.
can access it tax free, and you can pass it on to your generations tax free. That's
Great.
like, it's a no brainer. But just like in the all in one loan, it's like, it's too good to be true.
Right.
No, it
Yeah.
is, but it is true. But you have to have the right people setting it up.
Yeah. Yeah. Remember what I said back at the beginning. I mean, this is the all-in-one is the way that loans really worked prior to 1913 and the creation
Right.
of the Fed. You know, banks love the fact that they make 85% of your payment is going towards interest rather than principal
Right.
reduction.
Right.
And I tell people, I go, did you ever really stop to think, if let's say you've got a 6 or 7% mortgage today and rates go down to 5, and the bank calls you up and says, hey, Carla, would you like to refinance? We can drop you down to 5. Why are they so anxious to lower my rate?
Because it
Because the
starts
rate
all
doesn't
over.
matter. Yeah, because the rate doesn't matter. It's the
Right.
percentage of your payment that they're getting to keep. They would rather have 85% of your 3% rate than 50%, of your, 9% rate. So,
Right. Exactly.
so yeah, we'll gladly drop your rate. And that's just, that's sadly the way it is, but that sort of mentality has been ingrained into us. And, um, it's a sad thing. And the idea of just, paying off your mortgage, owning your home free and clear. I mean, the all in one is designed to help people that want to do that. There's
Mhm.
no better,
Right.
safer, faster way to pay it off than the all in one.